Chapter 7, Capital Asset Pricing and Arbitrary Pricing Theory. So this chapter is about the asset pricing models in finance. So let's start from capital asset pricing model. Capital asset pricing model, usually just called a CAPM. This is actually start from the single index model. Single index model, we learned this model in chapter 6, which is a model to show that expected return on certain stock, actually expected risk premium of certain stock equals to, there's a factor of the market risk premium, this is market risk premium, plus alpha plus error term, right? So we start from this, and these models show that there's a certain relation between the risk premium of the individual security and risk premium of the market. The reason that we call a single factor model is there's one factor, this which is the market factor, to determine the expected return on individual asset. So first of all, securities require rate of return related to the systematic risk measured by beta. It means that, well, so this is the risk premium, right? This is also, we can write using the uppercase, uppercase R. The risk premium of the market is actually related to the market variance and the risk aversion of the individual investor. And there's a definition called the market portfolio, which is the market returns. And it means that each security held in proportion to market value. So you have to hold all securities in the market. If you are in the US market, then all securities in New York Stock Exchange. And the proportion should be the same as the market value proportion. So these are the assumptions that CAPM make. So the left side is about market, the right side is about investor. The first assumption, all investors are price taker. The price taker is the individual investors basically, who accept the prevailing price. So you take the price, you accept the price, you believe this price is the right. Number 2, all information relevant to security analysis is free and publicly available. This is a very strict assumption. It's called information asymmetry. So information symmetric information assumption. Information symmetry basically assumes that every information is equal to everybody, which is not really realistic, but we have to assume this assumption to make this model work. Now, all securities are publicly owned and traded, so there's no really private owned securities. So this model usually just works for the stocks in the publicly listed firms. No tax. So we should not include the tax in this model. No transaction cost, so no cost. And lending and borrowing at the same risk-free rate are unlimited. In fact, first of all, everybody has a different rate of lending and borrowing. But we just assume that everybody just can borrow and lend at the same rate, which is the risk-free rate. And the amount is kind of unlimited. Now, the assumption about investors is now investors plan for the same horizon, which means that this is single period model. So we don't worry about reinvestment, things like that. We just believe that investors invest like a single horizon. Number 2, investors efficient users analytical method. That's another condition for information symmetric. So investors have homogeneous expectation. They have same expectation, same ability to analyze the news, and basically everybody are kind of rational, efficient. So investors are rational, mean variance optimizers, which means that as we looked at chapter 6, when we find the investors find basically the optimal portfolio, risk portfolio, they have basically pick the efficient frontier, and frontier that dominate the other portfolios, right? Which means that if your mean the same, so average returns are the same, we always just pick the portfolio with a lower standard deviation, which means that if the returns same, we prefer the less risky asset. And the assumption is that investors are rational. So in equilibrium, so let's look at the single index model again. Expected return on I, it's a risk premium actually, is certain relation between the market risk premium, and there's alpha factor and there's error factor. This alpha factor called excess returns. This term is about the firm specific risk. Now, suppose every investor chooses to hold a market portfolio. Okay, market portfolio. And this market portfolio has its own efficient frontier, which is like this. So this is the market portfolio efficient frontier. Okay. You have efficient frontier, right, like this. And some point, if this is risk-free, then you can actually draw the linear tangent line, which is called the CAL from previous one. Now we call it capital market line because this is the CAL for market. So we call it capital market line. And there is optimal point. This is optimal risky portfolio, right? Now, because we have this CML, we can move up and down based on the risk aversion. If you're more risk averse, then you basically increase the risk-free asset, go down. If you're less risk averse, so you are risk taker, then you go up, adding more risk portfolio, reducing the riskless asset, right? So the risk premium of the individual has the two factors. First of all, there's a factor about the market portfolio risk premium, which is captured by this expected return on market from the single index model. And then second is the beta portion, because the proportional beta coefficients of the security on market portfolio. So this is sensitivity to the market. Now in equilibrium, now this, first of all, everybody hold a well-diversified portfolio, which means that we have to eliminate this firm specific risk. So everybody rational, right? So everybody knows that they should hold a well-diversified portfolio. So this is gone actually, the error is gone. And then finally, this excess return is actually also converted to zero, because so suppose you have positive alpha. You have positive alpha. It means that you have incentive to invest more, right? Because this is good one. If you invest more, your price increase, right? Because the demand increase, and you expect a return decrease, basically, right? To the point that the alpha becomes the zero, right? So if alpha is positive, it actually moves to this point to converge to zero. If alpha negative, now investors have incentive to divest this investment, right? The price decrease, return increase, so alpha again gets to zero. So in equilibrium, this alpha also converges to zero. So single in this model work, single index model work. So if so, then we have one lesson from here. There's called the mutual fund theorem. It's called that all investors desire same portfolio of the risky assets. So this is the same portfolio, right? Same optimal portfolio that all investors want. Then can be satisfied by a single mutual fund composed of that portfolio, which means that you hold a market portfolio, then everybody's happy. So really we don't need to analyze it because everybody has same expectation. It's a homogeneous investor, so passive strategy works, right? There are two, again, different strategy, active versus passive. Active strategy, we try to find mispriced asset by analyzing the security, right? Passive, we just leave it and get the market return. And now because we don't have an alpha, right? Basically, active investments try to find this positive alpha or negative alpha actually to divest it. Passive investors just believe them alphas get to zero, so we just take the market return based on the model. Again, risk premium of the individual is beta times risk premium of the market, right? And the thing is, if this works, then active doesn't work, right? Passive is better. And in fact, the passive strategy is costly, it's easy and efficient. Why people follow active strategy? Now there's one paradox actually arise here. So if no one does security analysis because everybody just believes that passive is good, then what make market efficient? Because the market market becomes efficient because of analysis, because of information. Nobody do that, then it's kind of random, just the returns, right? But it does not really randomly picked. It actually has some efficiency working. So this is kind of a paradox we have to think about. So again, the reason that alpha go away is now demand drive the price, so lower expected return. Basically, they all move to the level of the efficient pricing. So equilibrium risk premium has two factors, again, risk of market and risk aversion of the average investors. Now, if everybody hold the market, again, portfolio here, and you have CML here, then everybody is here actually. Basically, depends on how risk averse you are. So capital asset pricing model again starts from expected return and expected risk premium of the individual asset equals to beta I times expected return and risk premium of the market, right? Rewrite this. This is expected return on I minus risk premium equals to beta I times expected return on market minus risk premium free rate. It becomes like this. So expected return on certain asset equals to risk-free rate plus beta of this and risk premium of the market. Based on this, we actually can draw the line, linear line, between the expected returns and the beta, like this, which is called the security market line, SML. And from this, there's intercept actually somewhere, which is called alpha. So if your return is not on the SML and above SML or below SML, there's some alpha occurs. So this is positive alpha, this is negative alpha. And in fact, if you use the real data, then you're gonna have some alpha sometimes, because market's not really, the assumption may be flawed, right? The assumption we make in the CAPM model is not perfect. So this is called abnormal rate of returns on the securities in excess that predicted by this CAPM model. So graphically, see, this is SML, right? This is SML, and this is the market one. Now this is the one that you have to have if the beta is 1.2. This case, the risk-free rate is now 6%. Market risk premium, the market actually returns, not risk premium. So market return is where 14%, right? That's the expected return on market. And then we know that if the beta equal to 1, then still market return should be 14%. If beta is 1.2 and plug 1.2 from CAPM model, expected return on I equals to risk-free rate plus beta of I times expected return on market minus risk-free rate, right? So it's going to be 6% plus 1.2 times 14% minus 6%. It's going to be 15.6%. So its predicted return should be 15.6% based on the CAPM. And now if stock realized return is 17%, not 15.6%, then we have some alpha here. This is called abnormal return. The amount of abnormal return here is 1.4%, right? This cannot be explained by this CAPM model. There's some errors here. If the return is below here, like 14%, say, then there's a negative alpha. So alpha may be negative or positive, and CAPM model just assume that there's no alpha, but in fact there may be alpha or not actually. So really we use some data, historical data, to estimate this alpha and beta using the regression analysis. So how to use the CAPM? The application of CAPM is use this SML as a benchmark. So this SML may be benchmark for the fair return on risky asset, right? So we have some kinds of alpha that will be, go away. That will go away with if the model's right. So it may be benchmark, and then this SML also provide a hurdle rate for the internal projects, because this is kind of cost of equity, right? It's the cost of equity. This is fair return of the stock. So for the company side is the cost of equity, and if you do the internal project, then your cost of equity is basically the cost of the project, right? Because you don't borrow more money. So this CAPM model actually can be used as a hurdle rate for the internal projects.